What's a brokerage account? How do they work? And how can you use them to make money? Let's break it down. First, a brokerage account is a non-retirement account that is set up by you. These are typically for short to medium-term investments or for people who aren't able to contribute to retirement because they've already reached the limits or their income is too high. They can also use this for longer-term investing as well. In a brokerage account, you contribute the amount that you want to it, either typically just as a one-time contribution or as recurring contributions to happen either weekly, bi-weekly, monthly, annually, or however you want to choose to set it up through that company. A general finance tip is to continue contributing to your accounts over time so that instead of just trying to time the market, you spend more time in the market using what we call dollar cost averaging, where you aren't trying to time the market, but you're just continually buying, and statistically and psychologically, that works out a lot better for the vast majority of investors. Third, you choose how you want to invest that money. And do not forget that step. Tons of people forget to invest their money in brokerage accounts and Roth IRAs, and you have to make sure you do that. Otherwise, your money is just going to sit in a cash account where it might gain some interest. But generally speaking, you're going to want to get your money working and invested for you. Because this isn't a retirement account, that means there are some limitations on how you can contribute. So this is entirely through after-tax funds. So you've already paid the taxes. It's already the funds typically that are in your bank account. Sometimes you can do a check or some unique setups if you have a unique employer plan. But these are not like Roth IRAs or Roth 401ks, which are totally separate types of accounts. And those have huge tax incentives, while a brokerage account still does have some tax incentives. If you want to learn more about those, make sure to watch my videos on Roth IRAs and Roth 401ks. There are still tax incentives for brokerage accounts by giving you the option basically of paying capital gains or income tax depending on how long you hold the investments. Don't worry, I'll break that down soon. There's also no limit to the amount that you can contribute to a brokerage account, which puts this in a really good place for people who aren't able to contribute anymore or they want a short to medium term investment. Now, for the taxes on brokerage accounts, you either pay income or capital gains tax. You pay income tax on assets that are held for less than a year or on most dividends. You may also be taxed on investment turnover. So if you have a fund that's continually trading stocks all the time, then there's a chance that you might end up paying some income tax because of that turnover. A huge benefit of brokerage accounts is that you can actually claim losses if the market went down and you either sold or exchanged those funds, and you can claim up to $3,000 of less taxable income a year. This does not mean that you're saving $3,000 in taxes. It means that if you made $53,000 a year and you sold and you lost $3,000 in the market, then you can claim a $3,000 loss and make it look to the IRS as if you only made $50,000 through that year. And this lowers your tax bill by up to $3,000 times whatever your tax rate is, and we'll also break that down soon. There are also capital gains tax that you can pay in a brokerage account, and these are for assets that are held for longer than a year and some qualifying dividends. There's a lot of nuance for what goes on in a qualified dividend, so feel free to pause and read if you want to learn more about that. In the US, we have a progressive income tax system, meaning your tax rate goes up as your income goes up. However, there are marginal rates where this increases. For example, if you made $10,000 in a year, then that means you would pay 10% on that $10,000 and you would pay $1,000 in taxes. This goes on all the way for $11,600, and then the next dollar you make after that, you are now charged 12%. So you only pay more in taxes for the next dollar that you earn after those different thresholds. There's also a lot of nuance on whether or not you're single or if you're married, you're filing separately, so feel free to go to the IRS website and read more about that if you want more info. There are also capital gains taxes in brokerage accounts, but that is a huge incentive because typically those rates are lower than what your income tax rate is. And those rates can be as low as 0% if you fall under certain income thresholds. There's a ton of nuance here, so feel free to pause if you want to look through those details as well. Now the fun part, the investments themselves. You have three choices of stocks, bonds, or mutual funds where you hold all of them in one compilation. So for stocks, that's buying something like Apple, Google, or Microsoft. For bonds, that's essentially you loaning money to a government or a company, and then they're going to pay you back with interest. Lastly, for mutual funds or ETFs, those are compilations of tons of different stocks. So rather than buying just one company at a time, you now are diversifying across tons of different companies. Examples of this are VU, which is replicating the S&P 500. That's 500 and change of the largest companies in the US. Or VT-SAX, which is a total stock market index that tries to get a larger portfolio throughout the stock market. If you're lost and don't want to make that decision on your own and you're terrified of what investment to choose, you can open robo-advisor accounts where they can help narrow down your investment choices for you based off of what goals you have and your risk tolerance. And it can save you a lot of heartache from having to choose investments, and they can try to help get you to the right spot. If there is one takeaway I want you to have from this video, it's that you do not want to keep your emergency fund in a brokerage account unless it's in a cash account. So if you have $2,000 in a savings account and you have no emergency fund anywhere else, do not consider the $10,000 you might have in a brokerage account as an emergency fund, because when the stock market rains, it typically pours. That typically means there's layoffs and the stock market might be crashing. So if two bad things happen at once, now your stocks might be worth half as much as they were when you had a job, and now you're going to just be hurting so much more when you pull that money out. So don't fall into that trap thinking that you're going to have access to those funds, because it might crash at the same time that you lose your job or get laid off, and I don't want you to be stuck with that. So try to make sure you have a 3 to 6 month emergency fund and a high yield savings account or a cash account within your brokerage accounts, and let your brokerage account be for your investments and not your emergency fund. If you want to learn more about Roth IRAs and 401ks, click on these videos here and follow for more finance tips.